Ladies and gentlemen, good day and welcome to Aditya Birla Sun Life AMC Limited Q3 and 9M FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Meghna Luthra from InCred Equities. Thank you, and over to you, Ms. Luthra.
Thank you, Renju. Good evening, everyone. On behalf of InCred Equities, I welcome all to Aditya Birla Sun Life AMC's third quarter, 9 months and FY26 ended earnings conference call. We have along with us Mr. A. Balasubramaniam, MD and CEO, and Mr. Pradeep Sharma, CFO. We are thankful to the management for allowing us this opportunity to host them. I would now like to hand it over to Bala sir for his opening remarks. Over to you, sir.
Yes. Thank you, Meghna, and good evening, everyone. And thank you for joining us today. Let me begin by extending my warm wishes for a happy and prosperous New Year to everyone. I hope you all had the opportunity to review our earnings presentation, which is accessible on both the stock exchanges and our company website. Let me start by outlining the current economic outlook and providing an update on developments within the mutual fund industry. As is known, the global economy has entered a phase of recalibration, and despite persistent tariff tensions and policy volatility, growth is stabilizing towards trend levels of approximately 3.2% as estimated. Nations are fundamentally reassessing supply chains and trade partnerships in response to these disruptions and continuing. And meanwhile, inflation continues its moderating trajectory, allowing central banks to pivot their focus towards supporting growth. This conversion signals a shift from crisis management to a strategic adaptation. India continues to outpace global peers with remarkable consistency of real GDP is on track to expand by a robust about 1.4% in FY26. Now, while CPI inflation has moderated to a favorable 2.2%, the gold-like movement of strong growth paired with low inflation continues, and we maintain a positive outlook for FY27, projecting nominal GDP growth of 9.75%. This optimism is underpinned by several factors: the transmission of monetary and fiscal stimulus, expectation of easing of tariff pressures, robust rural demand supported by strong agricultural output, and continued fiscal support for rural India. We anticipate inflation to normalize around 3.75%, well within the RBI comfort zone, and preserving space for growth supporting markets. Conditions appear favorable for a capital expenditure cycle, with the capacity utilization at elevated levels and healthy corporate balance sheets. While global uncertainty remains a key risk, India's fundamental position is strongly for sustained growth momentum, and hopefully the budget should also drive the future growth more aggressively. Indian equity markets hold a tale of two forces in this quarter: external pressures testing resilience and domestic strength raising the question. There was intermittent volatility with the global uncertainties, FP outflows, and profit booking pressures. These downward movements were largely offset by robust domestic institutional participation. Overall, equities concluded the quarter on a firm growth, the structural strength of India's equity ecosystem, despite short-term market fluctuations, as we have witnessed in the last few days as well. Continuing with the mutual fund industry update, the mutual fund industry quarterly average AUM stood at 81 lakh crore as of 31st December 2025, compared to 68 lakh crore as of 31st December 2024, registering year-on-year growth of about 18%. The industry recorded SIP inflows of approximately 31,000 crores for December 2025, reflecting quarter-on-quarter growth of about 6%. The total number of mutual fund folios stood at approximately 26.97 crores as of December 2025. During the Q3 FY26, the industry saw of approximately about 30,300 crores across equity and debt funds, with equity collection predominantly driven by sectoral and thematic and flexi-cap funds. Individual average AUM for December 25 stood at 49.28 lakh crore, contributing about 60.1% of the total AUM. And B30 cities with an average AUM of 15.12 lakh crores, accounting for 18.4% of the total AUM, growing by 18% year-on-year. At Aditya Birla Sun Life AMC performance highlights, our overall average assets under management, including alternate assets, now stand at 4.81 lakh crore, highest ever AUM achievement, growing at 20% year on year. Our mutual fund quarterly average AUM has reached 4.40 lakh crore, representing 14% year on year increase. And within this, our equity mutual fund quarterly average AUM stands at 2 lakh crore, growing by 11% year on year. As an AMC, we firmly believe that the SIPs continues to remain a cornerstone of our long-term investing in India. Our SIP contribution for December 2025 stood at 1,080 crores, supported by 40 lakh contribution coming from SIP accounts. In alignment with these visions, we have launched a new SIP-led initiative under the Investor Education Program Plan for Life. This campaign goes beyond wealth creation. It encourages the investors to think long-term, plan for life milestones, and importantly, prepare for retirement through systematic withdrawal plans. Our total number of investors folio for December 2025 stood at 1.08 crores, witnessing 3% year-on-year growth. We are driving growth by building scale through increased market attraction. Our overall fund performance has improved significantly, leading to better market perception and importantly, stronger flows into our core product. Rather, the momentum gives us the confidence. Building on these strong foundations, one of our key priorities continues to be strengthening our core equity offerings, particularly flexi-cap fund and multi-asset fund and our balanced advantage fund, as well as some of the thematic funds that we have been seeing close, like conglomerate fund, as well as the consumption fund. These are some of the key product focus that reasonably improved flows coming on this segment. Our focus remains on scaling these flagship products through a combination of SIP inflows, robust contribution across all distribution channels, improved fund performance, and increased market engagement. Our drive to build scale through enhanced actions coupled with improved overall performance has led to better market perception and rising flows in core products, creating momentum for continued growth. Turning to the alternate business, the PMS and AIF equity segments have demonstrated robust momentum, supported by a steadily expanding suite of credit offerings. We continue to enhance and refine our solutions to address the evolving sophisticated requirements of HNIs and family offices and some of the institutional investors. Our PMS AIF advisory assets experienced substantial growth, expanding from 3,853 crores year back to 32,000 crores in Q3 FY26, representing 8 times increase in the size. Of course, the winning of ESI's mandate accounted for about 28,000 crores as of December 31, 2025, while our PMS and AIF AUM, excluding ESI's mandate, registered a strong year-on-year growth of about 70%, reflecting a robust organic momentum in our core alternate business. And during the quarter, we received ETF allocation letter appointing us as one of the managers for the fixed income mandate. They are now progressing through the required regulatory formalities and expect to be on board of the assets in maybe before the current quarter ending. On the fixed income credit side, we successfully completed the final closure of our ABSL India Special Opportunity Fund Series 1 commitment of around 500 crores during the quarter, and currently have fundraising underway for Series 2 ABSL India Structured Opportunity Fund 2 and money managers. We are also preparing to launch ABSL India Select Sector Fund under the AIF category in equity. Our real estate business has built significant momentum and gained considerable traction, driven by strong investors' interest and robust deal pipeline. And during the quarter, we launched Aditya Birla Real Estate Credit Opportunity Fund Series 2. They are category 2 AIF focused lending to post-approval, brownfield across Tier 1 cities. 700 crores, registering year-on-year growth of approximately about 44%. The offshore average AUM stood at 4,841 crores. We have incorporated our newly owned subsidiary company, Aditya Birla Sun Life AMC International IFC Limited, in GIFT City to expand our GIFT City operations, and are currently in the process of securing regulatory approvals, and hopefully before the quarter ending, it will be up and running. We continue to see flows through our current branch setup across our existing funds, such as India is the Engagement Fund, ABSL Flexi-Cap Fund for Inward Remittance, and global blue chip fund for outward remittance under the LRS scheme delivers globally competitive solution to our investors. Our passive business has continued to demonstrate good momentum with quarterly average AEM touching 38,600 crores, representing a year-on-year growth of about 28%, and customer base expanding to 15.1 lakh folios. Our ETF offerings have witnessed robust traction with the ETF quarterly average AUM growing by 40% year-on-year, significantly outperforming the industry ETF growth rate of about 24%. We are building towards better long-term outcomes by improving on tracking differences as a key focus, while also improving in tracking errors. Last year, industry-wide, we witnessed good inflows in precious metals like gold and silver, and our offering in this space make an exceptional case for diversification. As of today, our passive product suite comprises of 52 distinct offerings across the fixed income, commodities, and multi-asset fund, designed to address the diverse investment needs of our investors. Moving to the financial performance, Q3 FY26 revenue from operation stood at 478 crores, up 77% year. Q3 FY26 profit after tax was at 358 crores, up by 19% year-on-year. FY26 profit after tax stood at 270 crores, up by 20% year-on-year. Our 9 months revenue from operation stood at 1,387 crores, up 10% year-on-year. Our 9 months profit before tax stood at 1,046 crores, up by 11% year-on-year. And profit after tax for the 9 months stood at 788 crores, up by 12% year-on-year. With this, I would like to open the floor for any questions that you may have. And I will be joined by Pradeep Sharma to answer any questions that you may have.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Mohit Mangal with Centrum. Please go ahead.
Yeah, am I audible?
Yes, you are.
Yes.
Please go ahead.
Yeah, thanks for the opportunity. So my first question is towards the employee benefit expenses. So even if I remove that labor code extra cost, the employee benefit expenses were higher by around 20% YOY. So what explains this increase in employee benefit expenses?
Yeah, Pradeep is answering. Yeah.
So Mohit, actually employee benefit expenses have gone up YOY. Basically on 2 counts. That is, one is the additional impact of the gratuity based on the new labor code, right? Which counts to around 2.82 crores. That is one. Second is on the ESOP cost. This is actually our parent company ABCL. Some ESOP were given to our select employees. So there is a cost of ESOP of around 4.66 crores for this quarter. So these are the 2 which are actually increasing the cost for the quarter.
Okay. So going forward, we should expect this to be recurring, or is it one time?
No, so gratuity is a one-time cost. It's not recurring. And the ESOP cost would be there for next 4 quarters, 3 more quarters on this account.
And that is basically for this rolling out of ESOP option for the employees in the recent board meeting. Yeah.
Understood. And secondly, if you can share segment-wise yield.
Yeah. So equity, our yields are around 65 basis points. And for that, it is around 24 basis points, and liquid is around 13 basis points.
Understood. Yeah, and in terms of this PMS and AIF, can you give some revenue numbers for 9M and Q3?
Yeah. So the alternate revenue for Q3 was around 34 crores, which is around 4.5% of our total revenue.
That is helpful. So lastly, on yield, so how do you see yield actually going forward for the next year, 4 to 5 quarters? Do you see a meaningful decline? How do you see the yield basically?
Yeah. I think broadly, Mohit, I think at this point of time we estimate the impact of the circular would be minimal, and to the extent very limited impact we should see. At the same time, since we are looking at building the size, I think we are already seeing some kind of momentum coming in the overall key portfolios in terms of traction. So, to the extent as the size of the funds increases, because there is a corresponding increase in revenue, but may come at the marginal reduction on the other thing. But again, I don't see it very significant. At the same time, since we're also looking at building our other businesses, especially the alternate as well as PMS, and broader and overall basis from the AMC point of view, we should see an improved performance rather than any significant reduction in the fees.
Right. So when you say that yield is minimal impact because of the circular, do you mean to say that we'll be able to pass on to the distributors?
No, I think we'll see it. I think as we come closer to the implementation date, of course, we will see how best it has to be optimally utilized for the benefit of everyone, keeping in mind the investor at the center. And with the preliminary assessment is actually we'll have to balance it out and ensure it has a minimal impact.
Understood. So my last question is on SIF. So your thoughts and when did we able to launch it?
Yeah. So in the case of SIF, we have already filed applications and the approval also is awaited. We thought that it would launch this month, and since we have asked for the revised structure in the portfolio, it's likely to be their approval is likely to come this month. I think hopefully in the month of February we'll launch it. By the time budget would also be out, and we'll be the first one to launch. Our first one will be launched in the month of February. We'll also, of course, plan to launch the equity long short fund. Making applications once we are confident that we have the talent pool to manage their fund once the person comes on board. So I think at least one fund will launch, which is a hybrid fund, which is the equity taxation, sometime in February.
Understood. This is very helpful, sir. Thanks, and wish you all the best.
Yeah, thanks.
Thank you. A reminder to all the participants that you may press star and one to ask a question. Next question comes from the line of Prayesh Jain with Motilal Oswal Financial Services Limited. Please go ahead.
Yeah, hi, good evening, sir. Sir, firstly, our fund performance has been improving, and quite a few schemes are appearing in the top quartile on 1-year return basis, and they contribute to a large portion of our equity AUM as well. But in spite of that, we kind of continue to lose market share on the equity side, as well as if I look at the SIP data that you've provided, that also keeps coming down. Now, how generally, it does take a lag effect, I understand, from a fund performance improvement to market share improvement, but still it's been some time that our fund performance has improved, but we still not seeing any even market share not being stable, right? We keep seeing decline month on month in terms of market share. So when do you see the effect of this fund performance, translating into market share gains, both on SIP as well as normal market shares?
Yeah. Thanks, Vayesh. See, I think the way I look at it is, I think if I look at the whole of last 1.5 years, the market share loss has been coming down in terms of as a basis points. That's something we are seeing. Now we almost come to stabilizing kind of thing. We are now almost come to a stage where it's now getting stabilized. That's one. Second is on the fund performance, moving from 1 to 2 and 3, and that's something we are already seeing it start reflecting most of our funds, while we have done very well on 1.5 years, is now start reflecting on the 3 years. Normally what happens is, as the short-term performance start reflecting the long-term performance, it comes as part of the recommendation list. We are already seeing that happening in the last 2 quarters. The number of approvals that is coming from the organized channel partners, that is something should be taken as a signal of products coming as part of the recommendation list, on basis which it's coming in. And second, some of the online platform where we also saw significant flows on funds which were top performing funds. We already started seeing some of our funds appearing in that segment as well. It takes some time for all these things to come in the so-called public domain. So I think these are some of the things we're already seeing it reflecting on net inflows coming in funds like Sun Life Equity, which is Flexicap Fund, Conglomerate Fund. We are seeing improvement in terms of flows. Balance Advantage Fund have seen good flows, and Multi-Asset Fund have got good flows. So I think that the category in which where we even see an industry-wide the LSS scheme. If I knock that off, and then other schemes they are getting the flows already begin. The SIP is drive. If I look at SIP number minus the SEP, SEP is something which comes from large ticket investors. They of course dynamically manage that, and therefore minus the SEP if you have to take it. I think we are already seeing the SIP numbers on equity getting better. Of course, there is no question that it has to gain further momentum given the fact that industry also coming in the segment. I think lastly, of course, from a sales team point of view, the high focus that we have been put in place in terms of improving the productivity of every RM across the country, with improved fund performance and reasonably high level of engagement and become of activities in the retail segment, which our retail team is doing it, I think should start reflecting in terms of improved performance coming on the numbers as we move forward. That I'm reasonably confident that the way things are shaping up. I think it will remain improve these numbers on a quarter-on-quarter basis. See, as far as the market share concerns, of course, if you look at top 10 players versus the rest of the players, we must also, of course, remember that overall market is expanding and more players are coming in. I think we also have to keep a close watch on our absolute performance improvement. In fact, when I look at this year, whole of this year, 9 months numbers, I'm close to about 16 crores of net sales that we got on some of our equity as a product. And overall as a fund house, we got almost about 45,000 crores of net sales. But these are numbers, they actually reflection of the confidence which the team, the team is driving the whole thing. I think improved performance will only further boost the confidence of the entire team across the country and the distributing partners to bring the numbers up. And that's something I'm already seeing it as the reflection coming from our Raj, are you there?
Yeah. Sorry. So if I got your number right, you said 4,500 crores of flows in this year, in this 9 months.
No. Total is about 50,000 crores roughly is overall as a fund house, including fixed income. And equity will be close to about 6,000 crores of inflows next year across all our equity schemes put together, including arbitrage funds.
Okay. And so
which I show it as a trend. I'm just saying why I'm saying Raj's number is not disclosed generally. It is number which generally we keep track of how we are progressing on quarter basis. Those numbers are not generally disclosed anywhere, but I am just going by the trend that I'm seeing. Like Flexicap Fund, I'm seeing some inflows. Multi-asset funds, we are seeing inflows. Maybe the rate of inflows could be lower, but I think what I see is actually the beginning of the reverse of the trend. Itself will gain momentum. Yeah.
Right. Sir, anything on the distribution side where you would want to take action, given that we are, there in the top quartile performance, any commission actions that you would want to take wherein you kind of increase a bit of commissions and take some pressure on your yields and get the volume growth which can help you? Is there anything of that sort as a part of the strategy?
So that's something we keep doing it as part of our strategy, products which can generate the volume. At the same time, if one has to consider for a brief period in terms of support the sales activities, that's something we do it. Already the focus product that I'm talking about it, the team do have some kind of flexibility to push for the volume. That's something we keep doing it. I think as we start seeing, we'll keep in mind, even for employees' point of view, in order to motivate employees here to run around the market, improve their productivity, we do incentivize them, drive with a lot of. But that's something we keep doing it. I'm sure this strategy will always ever evolving, and nothing is one time we have to do it. This anyway is a continuous process. We also run another segment-wise distribution partners, which we call the Privilege Club. Something again we keep driving it in order to help them improve their overall ranking and whatever we can do in terms of various activities that we undertake. That remains as one of our focus areas.
Got it. So last question, is your flow market share coming closer to, or is it very close to your backbook market share, probably in the month of December or currently in January? How is it kind of panning out? Is it very close to your backbook market share?
Yes, somewhat we can say. I think the way I see is the moment we see the rate of falling comes down, then somewhere it reaches the equilibrium, then we start reflecting on the reverse trend.
Got that, sir. All the best. Thank you so much.
Yeah.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Next question comes on the line of Dipanjan Ghosh with Citi. Please go ahead.
Hi, good evening, sir. So, a few questions from my side. On the expense side, if I look at your other expense run rate, and not looking at quarterly volatility, but looking at it more from a, let's say, rolling 12-month sort of a thing, it seems that the run rate has meaningfully been controlled, despite, you're kind of growing your alternate fees. You're also kind of probably scaling up your sales personnel on the MF side, given the traction in flows. So just to get some sense of, how should one think of the trajectory on the other expense side in case, let's say, you were to kind of scale up initiatives, given that your performance is not back on track. The second question is on the flow share. And, I'm trying to triangulate this math, that your SIP market share is like fully yet to stabilize. But obviously your redemptions are probably kind of narrowed down, resulting in improvement in net flow trajectory. So just from a channel perspective, would it be fair to assume that when performance improves, maybe the MFDs or the more assisted channels are the fastest to pick up in terms of both net new money and maybe lower churn rate? I mean, are you seeing that, or maybe I can stand corrected in case that's not the trajectory? The third question is on the similar lines. I mean, you mentioned some number on the flow part in reply to the previous participant's question. But you included arbitrage also. I mean, is it possible to give you some idea of the quantum excluding arbitrage? And just two data keeping questions, if you can spell out the employee number and SIP AUM number as of December 31st.
On the expense part, Pradeep, you want to answer? Yeah.
So, Dipanjan, actually the expense in our initial 2 quarters, we had our Vantage summit and growth summits across the country, and actually for this increasing the engagement of our distributors and investors. Q3 those activities have been low, and that is why you see that there was no increase on quarter-on-quarter basis. In fact, it is flat. But if you see on to-date basis, I think that average, would continue to be in coming quarters. So these all activities of our field engagement with our distributors and investors will keep on happening. However, there would be some quarter-on-quarter fluctuation when some few quarters will have those events, few quarters may not have. But I think the right way to look at is the to-date average.
Yeah.
Okay. And The employee number is currently it is around 1,680 people, 83 to be precise, and SIP AUM is around 87,000 approx, 86,984, around 87,000 crores.
Just to answer the other question, Dipanjan, as far as the channel concerns, definitely the organized channel, which is the banking channel, MD channel and MFD channel, which contributes roughly about 80% of the AUM, and we do have very strong relationship visible historically. The performance improvement definitely improves the confidence of our partners and go aggressively push it. And the MFD is one channel which we are already seeing some traction. Organized channels, of course, goes by the recommendation of the product, which I mentioned earlier. Some of the organized channel which sells, say, 3-4 products of each of the category, we are already seeing is coming as part of the recommendation list. Barring one or two where we are in the borderline case for the product to become part of our list. And as far as the ND is concerned, again, some of the products are now coming as part of the recommendation. As it comes as part of the recommendation list, then naturally there is a higher responsibility, ownership, and the incentive to sell the product from those channel partners. That I see the trend is reversing. As far as the online, which is the digital platform concerns, while we do have a presence with each of these partners, which built over a period of time, the strong partner for all of them. Given the fact they go by criteria they apply in selection of the funds, and some of our funds again coming as part of their the recommendation list, and therefore build a strategy around it. How do we get higher volume? We have seen this kind of volume coming in a few quarters back on some of the funds. Based on their understanding and evolving situation, that's something we push. I think largely, if I look at it, it will be a mix of all the channels, because we can't say this one channel. We as a fund house have got separate responsibility for each of the channel partners with the people around it, and therefore that's. With respect to the flows, I just give you a broader trend in terms of, though we don't give the individual fund-wise or category-wise flow, but overall equity category, I just give the number. I think broadly we can take it about 60 to 60-40 kind of ratio, 60 for advertising, 40 for other funds. So we don't give the individual numbers, but broadly that's the kind of mota you can take as a breakup.
Got it. So just to clarify, this was for 3Q or 9M, this data that you mentioned? The last data point on flows?
Yeah, 9 months, yeah, correct. 2 days, correct. For the full year, 9 months, yeah, correct.
And sir, if I can just squeeze in one small question, and thanks for the answers to the previous questions. Your performance is improving after some time, right? And what we've seen, over the last few years, for some of your peers where we saw a turnaround in performance, while AUM market share picks up, it never really recovers to the previous peaks, and maybe that's a function of market fragmentation, or maybe changing industry dynamics in terms of distribution, and difficult to kind of pinpoint. Having said that, in this environment, given that your performance improvement somehow coincides with a time frame when there's a regulatory change also, would it be fair to assume that you would want to kind of maybe take a differentiated stance with respect to payouts to your distributors, such that maybe there's motivation to kind of aggressively push your products a little higher, or would you kind of follow suit in terms of passing on the hit to the distributors?
No, as far as this growing the business concerns, that commitment, because if you have to grow a little faster, we would apply multiple strategies, which includes temporary incentive that needs to be provided for pushing the sales. Normally we do that on a select basis. It is nothing new to us. At the end of the day, we should also, of course, have a profitability target that we generally keep. We have to do the fine balance between profitability versus overall growth in AUM versus the revenue. That's something we keep doing it. I cannot say this will not do that. I think in our industry is so dynamic, so it's very difficult to take a single stand and basically push it. How that performance improvement is coming, performance pull comes, recognition comes, if the volume starts coming in, Therefore, we have to give a little bit of higher push. That means temporary adjustment on the pricing, which of course normally we are open. But again, we try to of course do the balancing between growing the size and maintaining the overall profitability expectations. That's something we'll continue to keep.
Got it. Thank you, sir. All the best.
Yeah.
Thank you. A reminder to all the participants that you may press star and one to ask a question. Next question comes from the line of Abhijit Sakhare with Kotak Securities. Please go ahead.
Hi, good evening, everyone. My first question was if you could indicate how have been the yields on the fresh inflows that have come up in the last couple of months compared to the overall book yields. And the context is just to kind of check this, with reference to your earlier comment that the idea will be to keep the yields intact, right? I mean, not just because of the telescopic decline, but also the new regulations that will set in from next year onwards.
Yeah, on the incremental price, more or less the same. There's nothing different. We are not done any force per se in this quarter. Therefore, more or less, the yield remains the same as what Pradeep mentioned earlier. The intent of maintaining overall yield, which is mentioning, given the fact, of course, the regulatory framework might have marginal impact, but broadly, the intention is to keep the trend on the margins more or less the same. So that's the attempt we will make through a mix of product, through a mix of momentum that we are bringing in certain high margin asset classes.
Got it, sir. And how should we think about the expense growth for next couple of years?
Yeah, so Abhijit, the expense growth would be the normal expense growth, no shockers on that account, except which would be like in line with inflation and closer to that. Mm-hmm. Except we may see impact of the new scheme, ESOP scheme, which we have rolled out in the month of January.
Yeah.
So next few quarters we will have impact on the manpower cost on account of this new ESOP scheme.
Yeah.
And otherwise, third quarter, right, sir? Sorry to interrupt.
Sorry. So otherwise, other expenses would be in line with the normal inflationary, except in employee cost on account of ESOP cost.
And that's already kind of showing up in the third quarter employee cost, right? The impact of ESOP?
Third quarter is not completely showing because the new ESOP scheme of ABSL AMC has been rolled out in January. Third quarter actually is having the impact of the parent company ESOPs given to select employees.
Yeah.
Mm-hmm. Okay. And possible to quantify that?
Over 3 years. Mm-hmm. ESOP will be spread over 3 years, which will have to make a provision. Yeah.
Okay. And so last question, I missed the data on equity flows that you mentioned in the previous question with respect to the 9-month flows, sir. If you could please repeat that.
I said overall the flows have been improving in the equity, and broadly I said as the fund house close to about 50,000 crores of inflows, which includes fixed income, equity and arbitrage, and within the equity I mentioned close to about 6,000 crores of kind of inflows, rough number. That's what I just mentioned. And within that, the focus product that we are pushing, which is the FlexiCap fund, multi-asset fund. In fact, we are also started getting close on the small and mid-cap fund, but though may not be the same order as what the industry is getting it. But these are some of the trend results that I am seeing on at least about 7 or 8 products in terms of flows improvement.
Got it, sir. Very useful. Thank you so much.
Thank you. Ladies and gentlemen, as there are no further questions, we have come to the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Yeah. Thank you, and thank you everyone for joining. And with this, we conclude our Q3 FY26 earnings call. If you have any query, you can of course either call or write back to Pradeep Sharma and Shivani Manka. Yeah. Thank you.
Thank you. On behalf of Aditya Birla Sun Life AMC Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.